Hey, welcome to our weekly segment where we guide you on your journey to financial literacy.
We like to make these videos short and sweet in hopes that you learn a new economic term while keeping you updated on 3 financial events that happened in the past week.
Without further ado, let's get right into it. GDP growth has averaged 6.4% in the first 2 quarters of this year, supported by significant improvement in the labor market. Last week's release of the July employment report showed a stronger than expected 943,000 increase in payrolls, the best month since last August and the second consecutive monthly gain above 900,000. This drove a sizable 0.5% drop in unemployment, bringing the rate down to 5.4%. This is consistent with many's views that economic momentum will be sustained this year by a healing labor market. At the same time, with wages increasing at a strong clip, investors shouldn't be surprised to see inflation worries and the implementations for Fed stimulus jump back into the spotlight. Many suspect that concerns over the Delta variant implications for the economic reopening will prompt some anxiety around the pace of GDP growth as well. Even beautiful markets have blemishes. Strong gains in equities coming into 1994 and 2010 were met with a jump in volatility, with markets experiencing a pullback as more pessimistic economic and monetary policy outlooks were priced in. Markets have been rather optimistic for much of this year, with US stocks reaching a new record last week and interest rates still at historically low levels. This does not suggest a correction is imminent, but pullbacks are a normal part of sustained bull markets. So this year in 2021, the S&P 500 has risen 98% from the 2020 low, including an 18% increase year to date. GameStop and inflation concerns prompted dips of 4% in February and May, but the rally this year has largely been free of any persistent drama. The growth scares in 1994 and 2010 proved to be temporary, with both passing as those cycles went on to log plenty of mileage. We think we've advanced into the mid-phase of this current economic cycle, having now moved into pre-pandemic GDP levels. However, we think there is still significant potential ahead for the economic and corporate earnings expansions, though the path higher is likely to be bumpier. While the Delta variant may disrupt the pace, we don't think it'll be derailing the broader expansion. GDP growth is likely to come in between 6 to 7% for 2021, with slightly slower but still above trend growth continuing in 2022. This forms a sturdy foundation for corporate earnings growth, which we think is the fuel that will power the market engine ahead. With more than 80% of S&P 500 companies having now reported second quarter results, the profit outlook remains bright, as earnings are up 101% versus the same quarter a year ago. 2021 S&P 500 earnings are expected to be 31% above the 2019's pre-pandemic level. The index is currently 30% higher than where it finished in 2019, signaling that equities have not become unhinged from fundamentals. Thus, many would view any instances of pre-pandemic or taper-induced volatility as attractive portfolio rebalancing opportunities. Anyways, that pretty much wraps up the financial news for this week. Now I'm going to hand it off to Om to discuss our financial term.
Hey guys, for this week's financial term, we're going to be talking about mergers and acquisitions, a really popular term in the financial world. First things first, mergers and acquisitions are two entirely different things. We just use the term M&A to generalize the consolidation or combination of assets between two companies. When one company takes over another company through the purchase of all its assets and debt, it's called an acquisition. Conversely, when two companies of about the same size combine their assets, it's called a merger. There are some exceptions to this rule, however. If a takeover is accepted as the best choice moving forward by both companies' CEOs or chief executive officers, then the deal is considered a merger, even though one company is still acquiring the other. However, in cases of hostile takeovers where the company being taken over doesn't want that to happen, these are still always considered acquisitions because there is no mutual agreement. Now, there are 6 types of mergers. The first one is a horizontal merger, when two companies in direct competition who have similar products marketing to the same market merge together. Number 2, vertical merger. A vertical merger is when two companies, generally a product provider or a supplier and a customer, merge together. For example, if Microsoft and AMD merge together, that would be a vertical acquisition. Congeneric mergers are when two companies who serve the same market but in different ways merge together. For example, in the fitness industry, you could imagine a treadmill company maybe merging with an elliptical company, right? They're both serving the fitness industry. Number 4 are market extension mergers. This is when two companies merge together that have the same product but sell it in different markets, thereby extending one company's market. And number 5 is similar to number 4 in that it is a product extension merger, where two companies are selling different products in the same market, although the products are slightly similar, and they try to expand their product base by merging together. The last type of merger is called conglomeration, when two companies that are very little or even nothing in common at all merge together. Mergers are also distinguished by how they're financed. There are two main ways of mergers are financed. Number 1 is purchase mergers. As the name suggests, this merger occurs when one company tries to purchase another company directly. This purchase is made with cash or through the issue of some kind of financial instrument. The sale is taxable, which acquires a lot of companies because remember, taxes are write-offs. So companies who like to get those tax benefits do tend to go for these type of mergers. The second type is consolidation mergers. This is when an entirely new company is formed and both companies are bought into that one entity. Now on to acquisitions. There are two main ways acquisitions are financed as well. A reverse merger is one way to acquire a company, whereby a private company buys a publicly listed shell company, or in other words, a company with no real business. Then the private company reverse merges with a public shell company, ending up with public tradable shares on the market based on the business of the previously private company. The other way acquisitions work is very straightforward, and it's just a purchase of all the assets a company has or all the debt, very similar to the purchase type of mergers. So the ways a company evaluates whether or not something is worth acquiring are endless, but here's some of the top three. Here are the top 3 most popular ones. So first, I'm going to start with the comparatives, right? Like the ratios you compare between companies that helps you to pick out the best company within a given sector or industry. Number 1 is a price to earnings ratio. This allows companies to buy another company as a multiple of earnings, right? And you can compare that to other companies in the sector to see whether or not you're getting a good deal. And this same thing does kind of apply to number 2, which is the enterprise value to sales ratio. You can always compare it to other companies with their price to sales ratios and even their EV to sales ratios. So again, it's easy to compare and be able to find the best deal, right? And the third one is a little more complicated. It's a very popular model among financial analysts. It's called the DCF, or discounted cash flow model. This kind of analysis is essentially when an analyst looks at a company's cash flows presently and even historically and attempts to predict their cash flows in the upcoming years. Then using those cash flows, they get a value for that company in the future years and then use a discount rate, which is generally accommodating for inflation and certain market risk requirements, to discount back to present value, right? Discounted cash flow. So trying to discount the future value back to the present. And whatever value they get then, they use it to determine whether or not the stock is overvalued, undervalued, or, fair value. Again, this is probably way too complicated, but we're trying to get a video out on this in the future. So please stick around for that. And yeah, that's about it, guys. Thanks for watching. If you liked the video, please subscribe and drop a like if you enjoyed it too. Really helps the channel. Thanks a lot, guys.